municipal bonds from Henyon & Walsh. If you have at least $10,000 to invest, call and talk with one of our bond specialists at 1-800-279-5279. We'll send you our exclusive bond guide, free, with details about how bonds can be an important part of your portfolio. Henyon & Walsh has specialized in fixed income and growth solutions for 30 years and offers high-quality municipal bonds from across the country. They provide the potential for regular income, are federally tax-free, and have historically low risk. Call today to request your free bond guide. 1-800-279-5279. That's 1-800-279-5279.
23 seconds away from the opening bell in New York this Tuesday morning. Good morning to you all. This is what we look like and have looked like throughout much of this morning. We're down 1% on the S&P. On the Nasdaq, we're down 1.6%, and still, we're off the lows by some margin. It was much, much worse this morning. Let's see opening bell. Switch up the board and get to the bond market. 10-year yields through 180, up 5 basis points now to 183. 2-year yields through 1% for the first time since February 2020. In the FX market, euro dollar 113.62, seeing a bit of dollar strength out there. We're down 0.4% on that currency pair. And crude in the commodity market, 85 earlier on WTI, 84.70-ish right now, up by more than 1%. We have a monster deal in the tech space, a $69 billion deal. Microsoft announcing that it is purchasing Activision Blizzard, uniting two of the biggest forces in video games. Wedbush's managing director, Dan Ives, joins us now on the phone with more. Dan, let's start right here. The obvious story for you and I. They are paying up what this stock was at 12 months ago. Dan, how unique is this opportunity that Microsoft has just taken?
Look, for Microsoft and Nadella, it was a golden opportunity. And they recognized that this was the time now or never, especially as every other tech stalwart couldn't bid given the antitrust issues. Microsoft knew it was theirs to lose, and that's why they went after it. And it's a significant deal in terms of the consumer strategy for Nadella, which is something he really wanted to ramp up.
Ginny Beale, our guest that's still alongside us, was opening up the conversation around the antitrust issues as well. Dan, as you look at them right now, is this a green light? Does this deal get complete? We're trading at about 87 around the open right now.
Yeah, I'd say it's about an 80% chance it gets done. There's going to be clear regulatory scrutiny in Brussels and the Beltway. I mean, it's the most heightened regulatory backdrop we've ever seen. Microsoft just did the largest tech deal ever. So this is going to be something that's going to get a lot of looks from a regulatory. I believe the deal ultimately does get done, but there's going to be a lot of questions that they need to answer in terms of the strategy around Activision going forward within the Microsoft flywheel.
Dan, you and I started this conversation by talking about how unique the opportunity is. I wonder how unique the headline will be this year. Do you expect more of the same thing from elsewhere?
I think it's tip of the iceberg. We believe there is going to be massive M&A in tech unlike anything we've seen. And when you look at the sell-off that we're seeing, then investors, are, to start the year, strategics and financial buyers, we believe, are waiting on the sidelines. Ton of dry powder. This is just the start of what we view as an M&A frenzy in tech.
Where are you focused, Dan?
I think you're going to see significant deals in cloud and cybersecurity. Here obviously was a consumer deal. Enterprise, that's really sort of $1 trillion of spend in cloud and cybersecurity. I think cybersecurity in particular, you're going to see a lot of deals in terms of consolidation, a lot of dry powder on the sideline, especially on this move to the cloud.
Dan, have you got names in mind?
I think specific names that stick out would be Tenable, Varonis, in terms of CyberArk as acquisition candidates. You could also see DocuSign potentially as an M&A candidate on a, what I'll call collaborative cloud. So I think this is one that it's just really the start. Microsoft doing a deal like this in terms of what we're going to see across tech in this fourth industrial revolution. And strategics and financials are on the side waiting for movements like we've seen over the last few months.
Dan, can you help me understand the names that you just went through? They're dance partners. Are they mega caps or similar size stories?
I think most of the deals that you'll see will be in that mid-cap land. You could see large cap deals that ultimately get done because of some of the moves that we're seeing. you look at Microsoft now, it's okay, does Adobe, do they get more aggressive in terms of M&A? Do you see IBM get more aggressive on M&A? Because as Microsoft's doing this, other strategics are watching this. But the conundrum and what continues to be, the unique situation is all that money, Apple, Amazon, Facebook, Google, they know any deal they do likely doesn't get done, and that's why they're on the, ultimately outside looking in.
Well, Dan, it takes me to Apple then. What on earth do they do with all that cash if they can't be part of this story as it plays out?
I believe Apple is going to spend a lot of money on sports streaming. I think that's going to be a significant endeavor, that they're going to spend from a content perspective. I could see some AR, VR acquisitions or potentially them buying ultimately a studio for the consumer business. And also, Apple's well aware that Microsoft's viewing this deal as the start of the metaverse. So this is really the broader story here. Is Microsoft's acquiring Activision as a gaming deal, it really starts this metaverse arms race. And that's something Apple's going to aggressively need to go after to keep up with the likes of Facebook as well as Microsoft.
Dan, that extends this conversation for another 30 minutes, but you and I can't do that this morning. Just a final one from me. What's the question for Team Nadella after what you've just seen this morning? What's your number one question? Main
question is, how do investors have confidence they don't take their eye off the ball on cloud? That's been the golden part of their success story. That would be the biggest worry here, that it taints what's been a pure cloud play story that's been a re-rating, in terms of the eyes of investors.
Dan Ives of Wedbush. Dan, I know you've got a busy one. Thanks for being with us this morning, buddy. Dan Ives on a $69 billion deal, which he says has got an 80% chance of getting done. That stock on Microsoft trades lower by about 1.5%. On Activision Blizzard up by almost 31%. We need to talk about Goldman as well. Goldman trading lower, sliding after reporting a trading revenue miss and a ton of expenses. The staff pay, Sonali Basak, is going higher.
It certainly is going higher, a 33% jump in compensation and benefits here. But remember, some of that is very variable. They're coming off a record year where they're seeing a 33% jump over the year in revenue as well. So Goldman matched exactly how much they were paying employees with that jump in revenue. With that said, you have global markets revenue coming off at one of its best years ever, the highest trading revenue in 12 years, still missing estimates. So you have that 11% decline in equities trading revenue really freaking out investors right now. I have to point out some very interesting numbers about Goldman Sachs because 45% jump in investment banking revenue. Just a humongous jump there that still for the quarter brings investment banking revenue down below where markets are. What does that mean, John? Even with investment banking revenue jumping, it still doesn't meet how much trading brings in even on a down day. Another really interesting thing that others will start to realize about Goldman Sachs is asset management revenue brought in for the year as much as investment banking did. What that means is you're seeing Goldman Sachs start to change, but can it diversify as quickly as investors want them to?
Sonali, thank you. Down as much as 8% on Goldman. This after JP Morgan got hit pretty hard in Friday's session as well. The overweight into the banks into earnings season was pretty clear for all to see based on the rally we saw on the S&P 500 banks. I need to talk about the fund manager survey at Bank of America as well. This is the quote. The bank's overweight surged to the highest since October 17. The tech overweight slumped to the lowest since December 08. The stock allocation for the US has dropped, but still we haven't gravitated to EM. But it's that banks piece I want to pick up on. Julie Beal, we came into the year and there was this rush to get that rate sensitivity, that rate exposure and get it through the equity market in the banks. And now we're finding out that the banks are paying up, expenses are going higher, the headcount's up, pays up. Is that the best way to get your rate exposure?
I would guess probably not. I think at the end of the day, everyone is trying to position themselves for a higher interest rate environment. And so the natural idea is to load up on banks, get rid of your tech. And I think through this earnings season, we're actually going to focus more on what the individual businesses are doing, the actual mechanics of how they generate earnings. And so I think you'll see more divergence in tech underperforming, outperforming based on how they're actually performing within their business, the actual fundamentals. So I look to see more divergence and more kind of quality coming ahead, people wanting real earnings in their businesses. And so when you have structural cost headwinds, that's going to be less appealing.
We're down 8% on Goldman to 350. Larry Adam, I'd love your view on this as well. If I want rate exposure and I started the year thinking banks, 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 do I still think banks, 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 but this time not the US, I think Europe instead.
I still think if you want some rate exposure, I still think those U.S. financials will give you that. I think the one fallacy was that you want to be in the cyclicals, but remember their cost structure is cyclical as well. And I think that that's kind of what you saw through this reporting season. But I think if rates do move modestly higher, I think that the banks and the financials overall will continue to excel in that environment. I wouldn't give up on technology. We like both sectors, financials, and I do like big cap tech. I think when we get into tech earnings, you're going to see the margins there being much stickier and resilient. And I think you're going to see that really catalyze the markets as we go into next week as those earnings start to come out as well.
The S&P 500 right now, just south of 4,600 at 45.97. Savita Subramanian of Bank of America came on the program with us a little bit earlier this morning on Bloomberg Surveillance with Tom Lisa and I. 4,600 year end. So basically where we are, this is where we end. She said something's got to give, and it's probably going to be margins. Bob Michael, something's got to give, and it's probably going to be margins. Do you agree?
Yeah, I think so. And I think what we're hearing and seeing is that the input costs into companies, some of that can be passed along, but a lot of it has to be absorbed. I listened to your very interesting conversation earlier about how workers want a greater share of corporate profitability. Even those workers that don't work for big corporations, that work in the small mom and pop shops, the small mom and pop restaurants, they want higher wages as well. And we're going to see higher wages. We're going to see higher prices. All of that's going to eat into corporate profitability.
Bob, I sense from you, you don't think this is a one-off. I believe the C-suite hopes it will be a one-off. I sense from you, you don't think it will be. Something I said earlier this morning is that I don't think this is just from the last 12 months. I think this has been building for the last 10 years of employees sitting down for wage negotiations every single 12 months, every single year, and hearing the same thing. Your pay's going up in line with inflation. It's 1 to 2%. Thank you. Goodbye. You're lucky to have a job. 10 years later, it just feels like, Bob, the dam has burst. And Bob, I don't know if you can put the walls back up and not revisit the same thing again next year and the year after that.
Yeah, I don't know whether you want to put the walls back up. I think you just have to accept that we're in a different environment where top-level consumption and real final sales is very strong. Prices are going up. Consumers want to be paid more, and that will support higher prices going forward. Maybe it's that normal that we've been looking for the last 20 years.
Bob, I want to finish on this with you because someone wrote in on Twitter, wow, has Bob Michael finally turned on high-yield credit when he had been one of the biggest bulls? Your opportunity just to speak to that, Bob.
Yeah, it is true. I do worry that the Fed has one life preserver, and it could throw it at growth or it can throw it to contain inflation. And it's just told us it's going to throw it at the inflation battle at the expense of growth because they've done enough for growth over the last couple of years. And I think in that scenario, you've got to pull forward your recession expectations. That means backup in credit spreads aren't buying opportunities any longer. So yeah.
Bob Michael, just to be clear then, what is your conviction trade? What's your biggest allocation at the moment? Are you saying you're overweight cash?
It's quality borrowers with little interest rate sensitivity, and that's really coming in the short securitized credit space.
Bob Michael, Julie Biel, Larry Adam. Bob, you and I have got another conversation to have at some point in the not too distant future. Maybe a little telephone call a little bit later to find out what's been going on. Thank you, guys. Appreciate it. Around the opening bell, about 12 minutes into the session, we're down 1.3% on the S&P. Coming up, Wall Street continuing to make the case for stocks in the year ahead.
The optimism still, because it's very early in the year, and right now we would expect we're right about where we should be with all the nervousness around the variant, the nervousness about the supply chain. When will that be resolved? The nervousness around a shortage of labor.
That was not Bill Winters of Standard Chartered. That was John Stolfus of Oppenheimer, and he is the biggest bull on Wall Street, looking for 53.30 on the S&P year end. We'll catch up with David Jones of Bank of America next.
This is Bloomberg's The Open. I'm Kriti Gupta. You're looking at a live shot of the principal room. Coming up, Howard Marks, Oak Street Capital co-chairman and co-founder. That conversation at 1 p.m. Eastern, 6 p.m. in London. This is Bloomberg.
Inflation is very high, and far too high, and we wouldn't want to see it persist at very high levels. We have a 2% inflation goal. So that is, it is very much on my mind and my colleagues' minds.
Earnings season heating up, but the focus is still on the Federal Reserve. According to Bank of America's latest fund manager survey, aggressive monetary tightening is the biggest tail risk for markets right now. With more, here's Abby.
John, well, that is the big fear, that central banks are going to normalize policy in a hawkish rush. Interestingly, though, the most favored asset class, equities. Equities by 55% are the overweight preferred asset class of managers. Meanwhile, bonds underweight by 77%. That's a massive divergence. Not surprisingly, has everything to do with those hawkish expectations of repricing of risk. Yields, of course, John, extraordinary action over the last year with the yield curves flattening as the Fed has sat on the long end but sold the short and the middle. That, of course, creates the 5-30-year at levels basically seen since early 20. But in the meantime, yields are rising. So that, of course, is creating the great rotation. Maybe you could call it the Goldilocks rotation, because the flattening yield curve, generally that favors equities until there's potentially an inversion. And in the meantime, again, yields higher, that helps the banks. So not surprisingly, investors, managers really favoring those banks by 41%, just 1% going toward tech, John.
Abby, thank you. A fascinating read, this one this morning, and I'm pleased to say we can talk about it some more with David Jones of Bank of America on the Global Fund Manager Survey. David, let's just start with your highlights, and then I want to come to your personal views on where you and the team think this is actually heading. Just your highlights first, please.
Yeah, so this is a relatively more bullish survey than last month. Investors are pricing in pretty much a Goldilocks scenario, like you said. And what this means is that the optimism from global reopening is outweighing the fears of a more aggressive Fed. What's driving this optimism about reopening is the reduced perception of the risks of COVID. Only 6% are seeing COVID as a top tail risk. Meanwhile, the Fed is seen as raising rates only 3 times next year. Inflation is seen as transitory. The majority see inflation as peaking and even being reduced over the next 12 months. And earnings growth, economic growth, and margin growth, all this is seen as rather stable. So it is a very benign view that's been priced into markets. From an investment perspective, what that means is that you are starting to see a rotation. People still remain very overweight stocks, very underweight bonds. People, in fact, are allocating away from bonds and towards commodities. And within equities, people are rotating away from growth and towards value. You have the highest overweight of banks since October 2017, and you see the lowest net underweight of technology since December 2008.
After seeing that as the most crowded trade since, I think, forever, I've said that repeatedly this morning, David. Your line is, we remain stagflationary bears on 22, a rate shock and a recession scare. What does that mean, David, just in terms of what you're doing in the market?
Well, what we see is a much less benign outcome than the investor survey. We see the Federal Reserve hiking not 3 times, but perhaps 4, perhaps even 5 times, 100 to 125 basis points of hikes this year. We see inflation as remaining an issue and being more persistent than the market seems to believe. And what this means is that a more aggressive Fed is going to have to move more quickly, and this could create a growth scare in the second half as the yield curve flattens or perhaps even inverts.
So, David, help me understand the sector bias. As you mentioned, and I repeated, it's the first time we've seen tech down here as an overweight at the lowest level since 2008. The bank overweight is the highest since 2017. And, David, the rate exposure is something everyone scrambled for to start 22. Now we're starting to find out how expensive some of that growth is for some of these names on Wall Street, David. And I think some people questioning, looking back at their holdings in the financials and wondering whether that's the right place to be. What's the sector bias for you?
Well, we have been saying, and we remain in this camp, that we like quality defensives. We think that staples and utilities are very inexpensive relative to the rest of the market. And, either you have this continued benign growth like the market seems to think, in which case utilities and staples make a very good hedge, a market hedge. However, they also make a very good macro hedge if things turn out more like we think they could in the second half and you get a growth scare.
This has been a fascinating read this morning, David. I know you and the team are super busy, so thank you for sharing some of your time with us. David Jones there of Bank of America on their latest Global Fund Manager Survey. For the equity market, 22 minutes in, we are down 1.5%. Energy, the only industry group on my screen right now in positive territory, breaking it all down. Here's Kriti Gupta.
Yeah, John, it looks like another day in the red for the S&P 500. A lot of that coming from that tech underperformance, really weighing the index down. But you also have a lot of the other sectors also being weighed down. When you have these kind of rate hike bets, it's not just tech that gets hit. It ends up becoming a pretty broad-based hit. That being said, energy, to your point, is the only leader following those oil prices higher as you see hedge funds actually pile into the commodity space, really boost their net long positions. But you also have geopolitical tensions and concerns that Russia isn't actually going to be able to keep up with the output that they need, boosting those energy prices. To the downside, though, consumer discretionary and communications, those, of course, holding your big tech names. But in that, a little nugget of green, and that, of course, is going to be those video game stocks this morning, all up after Microsoft said it's buying Activision Blizzard for $95 a share in an all-cash transaction valued at $69 billion. This would make it the biggest acquisition for Microsoft and the biggest M&A deal in tech history, John. Of course, perhaps giving just a little bit of wind to those video game stocks that have been under pressure for most of the last year.
Who's next? That's what people are asking. Kriti, thank you. Kriti Gupta on the sector price action in the bond market. Yields higher by 5 basis points on twos through 1%, the highest level since February 2020. That was the surprise this morning that got everyone's attention. I say surprise. We've been heading in that direction. The surprise on the year, a 30 basis point move. We're not even 3 full weeks into 2022. 30 basis points higher on a front end, 30 basis points higher on a 10-year too. Up next, your trading diary from New York. This is Bloomberg. At 25 minutes in, stocks lower. Stocks down and down hard in some places, off 1.5% on the S&P. On the Nasdaq, down by 1.8%. A single name for you, it's Goldman Sachs. At Goldman, the investment banking numbers decent, trading a little lighter, compensation higher, much higher. This stock lower, much lower, down 8% in early trading. That's some of the price action. Let's get you to your trading diary and what you need to be looking for this week. Bank earnings continue. Morgan Stanley, Bank of America tomorrow. Plus, President Biden holding a news conference to mark the end of his first year in office. We'll get another round of jobless claims on Thursday, followed by Netflix reporting earnings after the closing bell. to close out the week. From New York City, for our audience worldwide, thanks for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
Robotics, quantum computing, and more. Our crowd's accredited investors have already invested over $1 billion in growing tech companies. Join the fastest growing venture capital investment community at ourcrowd.com.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It's 30 minutes into the U.S. trading day on Tuesday, January 18th. Here are the top market stories we're following for you at this hour. The big deal is back. Microsoft is buying Activision Blizzard for $69 billion to push further into video games. The 45% premium sends Activision soaring. No glory for Goldman. Goldman Sachs shares sink 8% as a slump in equities trading and jump in expenses overshadow record investment banking revenue. And curveball. Treasuries sell off, the curve flattens, and the two-year yield tops 1% as Fed rate hike bets ramp up. Tech gets hit hard while energy gets a lift from the highest oil prices since 2014. From New York, I'm Kaylee Lyons with my co-host in London, Guy Johnson. Alex Steele is off today. Welcome to Bloomberg Markets. And Guy, there's a few idiosyncratic company stories out there. We have M&A, we have earnings, but on a macro global level, it seems to be yields really driving the market narrative.
You just ran through that headline sequence, and I was just listening to what you were saying. You got everything in there, haven't you? You've got the corporate results from Goldman Sachs. You've got the macro story with yields and what's happening with energy. And then the top story today, what is happening on the M&A front. We got a little bit of that out of Europe yesterday with the Unilever GSK story as well. Looks like it could still be an interesting year for M&A. So there's lots of ways of looking at this market. Let's talk about the data we're getting because while last week was packed, this week a little light as we build up to the Fed next week, obviously. But let's dig into the data that we do have. We're getting the housing market data. The National Association of House Builders number is out. We've come through a little light, but not much light. We've come through at 83 versus 84. Now, a little while ago, we were trading in the 90s. We faded that move, and then we've started to pick back up again. It's going to be interesting to see what a higher yielding environment is going to do to the housing market. Is it going to have an impact as we start to see those mortgage rates creeping higher and higher? Maybe as the Fed starts to withdraw a little bit of stimulus, that could be a play that's going to be worth paying attention to. But as we come back to kind of what we're thinking about today, the question of the day, I think, really kind of sums it up. In terms of the equity market, Kaylee, what is the most important story out there right now? Is it the earnings story? We've had Goldman Sachs today. We're watching what is happening carefully there as that stock sinks. Or is it the rate story? Now, here's my 2 pence worth on this story. 2 cents worth, maybe I should say. I think for the equity markets, Kaylee, it's yields. For the stock market, it's what's happening with the earnings picture. Basically, if you're looking at this from a macro point of view, it's a rate story. If you're looking at this from a single stock story and you look at Goldman Sachs today, then it's going to be the earnings narrative. Now, that probably just fudges the answer to the question. Let's get a more enlightened view of this. Let's bring in Bloomberg's Wall Street correspondent, Sonali Basak. She's definitely on the earnings story right now, and a little bit of the M&A story thrown in as the iBank performs over at Morgan Stanley, and Ira Jersey, Chief U.S. Rate Strategist for Bloomberg Intelligence. Sonali, those are my thoughts. What are yours? What do you think?
Yeah, it's a great question because it's so related. But if you look at the yield story, it's the cost of financing you're talking about there. Not everyone can be a Microsoft and buy things in cash. So what are we looking at here? Private equity is an interesting proxy here, Guy, because you see Blackstone shares on the year down more than Goldman Sachs on the year, even with this decline today. What does that tell you? It tells you that investors are very worried about the ability of investment firms, the ability of corporations to invest as yields rise. Now, if you take a look at that long-term yield curve here, the 530, it also shows you just how much it has flattened and just how much people will be worried as banks lend long, borrow short, and people really worry about that net interest margin moving forward.
Yeah, the 530 spread at the flattest since March 2020. You're seeing a lot more movement on the front end and a repricing of Fed expectations. So Ira, just to bring you in here, the 2-year yield north of 1%. You have a 10-year yield now trading at 183. Do these bond market moves look overdone at this point?
Well, certainly from a momentum perspective, the 2-year yield is certainly oversold a little bit here, but at the same time, we're basically pricing in for 4 hikes this year, which is the first time that we've done that in quite a while. So it's not a huge surprise that you have 2-year yields upwards of 1%, and they'll continue to go higher, assuming that we have a continued pricing for the Fed continuing to hike next year. Importantly, and I think just on the point of the 530s curve, if the Fed is going to continue to hike and will start running off its balance sheet, you can get that 530s curve all the way down to 20 basis points, so another 30 basis points of flattening. So there certainly might be some some worries about net interest margin, like Sonali was just mentioning.
Do you think the Fed is going to have an issue with the shape of the curve right now, Ira? Do you think it's going to want to do something about it? Could this accelerate the QT aspect of the sequencing story that we've been talking about?
Yeah, it definitely could. I don't think that sequencing is, the Fed is probably going to hike first and then at the next meeting after they hike start to run off its balance sheet. The question is, how do they do that? So in the past, they've wanted to do it very passively. They don't want to go out and sell bonds because they're not sure exactly how those reverse auctions would work. But I think it's important that if you do hear Jay Powell next week at the Fed meeting talk about the curve being too flat and worrying about what that signals for the economy, the Fed would actually have to hike less aggressively than they might like in order to get that curve to steepen, because 2-year yields are going to keep rising as the market continues to price for a more and more aggressive Fed, and that's certainly going to be the case if we continue to see inflation up where it is. So oil prices, for example, being up $1 today isn't helping that cause yet.
Well, and of course, Ira talking about the moves in the bond market, FICC volatility, in theory, would benefit banks on the trading level, but it was equity volatility that really seemed to hit Goldman here with that trading disappointing. What's the read-through going to be to the likes of Morgan Stanley tomorrow?
It's truly amazing because we know Morgan Stanley has been the longtime leader in equities trading. But Goldman Sachs ended last year as #1 in IPO underwriting, which feeds through to those equity volumes. So what do you have? You have Goldman Sachs falling in equities more than JP Morgan, but that absolute number is still higher. So a lot of competition there in equities revenue, but how is that sustained through the end of the year? You also want that FICC volatility to remain higher, but if the issuance also doesn't remain higher, you start to have issues with overall volume. So it's awkwardly cyclical, unfortunately, for what the banks start to rake in.
Sonali, the banks, though, are a real microcosm of what is happening in the wider economy right now. You look at the cost story, and I'm wondering what the Fed is going to think about this when it looks at what is happening in the labor market. Now, the banking sector feels isolated from the real economy when it comes to this area, but nevertheless, I think it's instructive to see what is happening here. Costs are rising very, very quickly. They're having to pay for talent. That is eating into margins. Is that something that is going to be replicated more widely? I think is a question that the equity markets have to answer. And I think you look to the earnings picture here. Is this something that is going to carry on? I'm looking to the comments from Goldman Sachs. I look at the comments from JP Morgan last week. We are going to pay up for talent. Sonali, how much longer can they keep doing that?
So on one hand, some of this is variable because a lot of this is bonuses that are contingent on revenues. And now we have a lot of the banks guiding, don't expect a repeat this time around. So those bonuses are likely to moderate. But with that said, if you think about a big consumer bank, Bank of America has raised not only their own minimum wages, but the minimum wages demanded by the people who supply for them. So that has ripple effects across the economy. We'll be looking into April for what the proxy season looks like and the disparity between the CEO pay and the average worker at each of those banks. I mean, that could be a pretty stunning number this year. But even beyond all of that, there's another thing to throw in the crosshairs here, Guy, and it's that the idea of rates rising impacting the consumer. Mortgages, you were talking about, that is a big windfall for banks like JP Morgan, Wells Fargo. And so if that starts to be eaten into, then all of a sudden do you see consumer confidence also start to dampen and then float into other sectors as well?
Well, let's talk about just how high rates can continue to rise. Ira, already at 183 after starting the year around 150. Is this going to be a repeat of 2021 where the bulk of the move comes in the first quarter and then it stalls out?
It's very possible in that long end of the curve that that'll be the case. I think that the long end, though, will readjust based on, exactly how high the market thinks that the Fed's going to go. So I think one of the interesting aspects of how this year might shape up is we may be pricing right now for a very aggressive Fed, but a Fed that doesn't go very far. So, basically the Fed, if it hikes 4 times this year, maybe they're only going to hike 1 or 2 more times next year. That would keep 10-year yields probably right around 2%. But if the market starts to price for, say, a slightly slower Fed, but that they hike longer and to higher yield levels, so say the Fed funds rate up above 2%, that's when you can really see 10-year yields start to move higher and get up toward 2.25%, 2.5%. And I don't think that we're going to see last cycle's highs. So, we're not going to see a 3.25% to 4% 2-year yield, but 10-year yields all the way up toward 3% is certainly something that would probably crimp the economy, given we've been accustomed to these low interest rates for a long time.
Sonali, I want to wrap things up with you. Many of these banks that we're talking about here have huge prime operations. Those prime operations are getting bigger and bigger.
Yep.
What kind of risk tolerance is there within those prime operations when it comes to the hedge funds, when it comes to understanding the impact that the rate story is going to have on the equity markets and other markets, what earnings are going to do? We're going into a much more volatile period. You can see that writ large across just about every asset class. What is the attitude within these prime businesses to risk?
It's incredible because in the wake of Archegos, you have seen a massive shifting of prime brokerages on Wall Street, with Goldman and JP Morgan gaining just so much share. And hedge fund leverage remained pretty high last year at the end of it all. So what had happened in the wake of Archegos? Yes, there has been an onboarding of clients with a keen eye towards risk, but a lot of funds escaped a lot of issues in the last couple of years, not only in equity markets where many funds rebounded last year on top of high leverage, But in fixed income, remember the last couple of years, the damage that has been faced in the repo market alone with the basis trades and leverage that exceeds the amount that you're seeing in equity markets. So into the next year, how treasuries are being traded, how fixed income is being traded, how macro is being traded will be of very keen interest on Wall Street.
Indeed it will. Thank you so much to Bloomberg's Sonali Basak and to Ira Jersey of Bloomberg Intelligence. And coming up, we'll continue to pose our question of the day. Are rising yields more important than earnings to equity markets? Margie Patel, Allspring Global Investments Senior Portfolio Manager, will give us her answer. This is Bloomberg.
"14 minutes past the hour, or nearly. Let's get back to our question of the day. Are rising yields more important than earnings when it comes to the equity markets? Joining us now, Margie Patel, Allspring Global Investments Senior Portfolio Manager. Margie, thanks for your time today. Greatly appreciate it. Talk to me about what you see in these markets right now. We've got earnings season kicking off, but we've got rates moving higher. Which is driving the equity bus right now?
Well, right now we have a news vacuum as far as equity earnings. We started to see the financials start to report, and you can see pretty clearly earnings are much more important than rates. When you look at the results, say, of Goldman Sachs today, the market reacted much more to that. And I think that'll continue to be the case, that it'll be an earnings-driven story. I think rates are too low, even with some very modest increases. That's not enough to slow down the economy and derail an outlook for pretty good corporate earnings, I think, in this year, 2022.
Well, let's talk about why yields are moving higher, Margie. There has been a dramatic repricing of expectations for the Federal Reserve. Now 4 hikes priced in this year. Why do you think they will actually only move 2?
Well, because I think there's certainly no compelling reason to move aggressively with 4 hikes. Because from the Fed's point of view, when they look out, they see an economy that's still strong but probably decelerating this year. They still see the risks of COVID, which may have negative effects that we don't know about. And it looks as if the early signs are that inflation is actually starting to come down from that 7% level. And at the same time, you look at real average wages for workers, those have moved up. So those are all very, very positive things that the Fed would like to see continue. And so I really don't think that they see any need to aggressively act and move for 4 hikes. I think 2 will be plenty. The market's kind of done their job already. They've really flattened out the curve. And so that will mean the Fed is I think, in a position to sit back and watch and do very little.
If we only get 2, how should I reposition for that?
Well, again, I think the most important thing is what companies, what sectors will continue to have above average earnings in 2022. And clearly, I think if you look at the way the market has wobbled around so far this year, and even at the end of last year, you can see that investor enthusiasm for the more speculative sectors, the more very, very highly priced sectors, a lot of that enthusiasm has deteriorated, not because of anything the Fed has done, but simply because people are a little bit nervous about what may be overvalued looking out into the new year. So I think earnings will be the story this year. Looking for those companies will really be the task, and we think the companies that have proven long-term growth will continue to do pretty well.
Do you think margins can continue to hold in there, Margie?
Well, it's amazing how long they have. And yes, I think they can, because we've seen companies either produce more with less workers, which they've done during COVID, or they've been able to, again, innovate and improve the worker productivity, so they have been able to maintain those margins. So I'm not really looking for any margin squeeze. And companies have so much liquidity. Microsoft buying Activision today is a great example of so much cash they could buy whatever they want. Says that they really aren't going to be much affected if we see short-term interest rates go up, because they aren't really needing to increase their borrowing. And so companies are really in pretty good shape. And so I think the margins are once again going to surprise by maintaining at those very high levels.
Microsoft has plenty of dry powder, plenty of firepower, as you say. A huge balance sheet. It's maybe starting to leverage that. Other companies don't have that luxury to the same degree, Margie. If we do see yields going higher, dragging credit up with it in terms of the yields there, do you think that will put a crimp on the M&A story this year, or do you think actually there is a need to rotate portfolios, there is a need to consolidate businesses as maybe some margin pressure starts to creep in?
Well, I really see corporations being in great shape. They've used the last couple of years of very low rates across the board to raise cash, to lengthen their maturities on their balance sheets, to pay down the banks, and to lock up very long-term, very low rate interest rates. So companies, whether they're huge companies like Microsoft or even smaller companies, have more cash on their balance sheet than they've ever had, so they have the flexibility. They learned the lesson during the financial crisis about the importance of that. So most companies have had excess cash flow. They've improved their balance sheet with these very low rates, so they really have no need to increase their borrowing to make an acquisition. They actually have a lot of cash, not just huge companies like Microsoft, but even medium-sized or small companies, to make an acquisition for virtually cash thanks to their improved balance sheet. Corporations have great balance sheets, and so do consumers. So it looks like a couple quarter point moves is certainly not going to have any negative effect on corporations or on consumers either.
Well, obviously there has been, though, a negative effect when it comes to tech of higher yields. We've seen that really underperforming. A rotation into value has taken shape, yet we've seen the start of a value rotation time and time again. It never really seems to stick. Do you think this one will?
No, I don't, because those are really short-term trading reactions to anticipated changes in interest rates or in the yield curve. They really aren't reflecting fundamentally future earnings growth from these companies or the market multiple you're going to put on the price of those future earnings. So I think it's a little bit of extreme volatility while we have this news vacuum before we start to see the whole fourth quarter and outlook for 2022 being reported over the next few weeks.
All right. Thank you so much for your insight today. Margie Patel of Allspring Global Investments. Appreciate your time. And coming up, we'll get back to that big deal. Microsoft buying Call of Duty maker Activision Blizzard for $69 billion. That's Microsoft's largest purchase ever. And we'll have the details next. This is Bloomberg.
Beast mode? Nah, bro.
Earnings season is coming.
Q4 earnings are going to be awesome.
Bloomberg is fastest with the numbers and analysis.
Amazon crossing the Bloomberg terminal.
Where are investors seeing the weaknesses?
It means profits down the line.
Earnings season on Bloomberg Television and Radio.
tech. Call it Merger Tuesday. A blockbuster deal will unite two of the biggest forces in the video game industry. Microsoft is buying Activision Blizzard in an all-cash transaction valued at almost $69 billion. Here with more is Bloomberg's Leanna Baker, who leads the deals team here in the U.S. Leanna, obviously a massive deal. Analysts say it makes strategic sense, but this is a big tech company trying to make a big acquisition. What kind of regulatory scrutiny could this come under?
This is exactly the angle that we're watching. Microsoft so far has escaped the scrutiny that some companies like Meta, formerly known as Facebook, or Alphabet have seen in Washington under, FTC's Lina Khan, which big tech is very scared of. So we'll have to see if Microsoft faces pushback. I can imagine that with gaming so mainstream and touching the consumer in so many ways, this is something they're really going to look into. Some questions that regulators will be thinking about is, will Microsoft be too dominant in gaming? They already own Xbox, and they do make some software like the Halo games. Owning the Call of Duty franchise will give it even more power in the market. I'm curious whether Electronic Arts, for example, Activision's biggest rival, will be fighting this. There's many questions and also many different regulatory bodies all over the world. Microsoft has a footprint in China. Is this going to face review there? And what about the EU? So this is going to be a really drawn out, protracted review that we could be watching for years potentially.
Yeah, this is about gaming, but it's also about the metaverse. How should we think about the metaverse from an antitrust point of view? We don't even know what it is yet.
Well, it has the sort of buzzword thing that regulators might want to look at because they know they'll be in the headlines, or even politicians should they look into this. Halo has been online for a long time, being a virtual online multiplayer game. So certainly Microsoft's role in the metaverse and how dominant it will be is going to be something on people's minds.
Obviously, the elephant in the room is that Activision Blizzard has been mired in somewhat of a cultural controversy over the last couple of months as it relates to gender in the workplace, and yet the CEO is staying in his role. Is that just for the acquisition, or is that a long-term Microsoft bet on Bobby Kotick leading the company?
If you take a look at the wording in Microsoft's press release, it's worded in a very specific way. To me, it's a bit unclear what Kotick's role is going forward at Microsoft. To me, this seems like an elegant exit for some of the issues that Activision has had, since now it'll be Microsoft's problem. Gaming in general has had harassment issues across the board, so it's not just Activision that's faced some of these issues, but certainly it is interesting that given how much it's been in the headlines, that all of a sudden it's acquired here by Microsoft.
Liana, we're going to leave it there. We're going to continue to watch it, though. Liana Baker joining us on this huge deal that we've seen announced today that will take quite some time to clear regulatory scrutiny. It's a huge win for Goldman Sachs. Goldman Sachs is the advisor to Microsoft on such things. Today, shares, though, down quite a lot. This on weak trading. Actually, investment banking performing really, really well. We're going to talk next to an analyst who's got an overweight on the stock. We'll get Jeff Hart's take on what is happening here. He's joining us from Piper Sandler. That coming up next. Microsoft, certainly a huge story, I would have thought, for Goldman Sachs. But today, the focus very much on the earnings picture. Wages, costs, a massive story here. Anyway, we'll get Jeff's take on that next. This is Bloomberg.